This chart shows the recent performance of American stocks. Looking at the upward trend, you see a market nominally returning an 18% gain denominated in US dollars, creating a strong sense of prosperity. But look what happens when we price that portfolio in real purchasing power, gold, instead of fiat currency. The reality is, American stocks crashed by 28%. While investors celebrated their paper gains on the evening news, their actual wealth was silently destroyed by an invisible economic force. The root of this destruction comes down to a simple mathematical reality. The United States is sitting on $38 trillion in national debt, and the fiscal deficit is growing much faster than the economy itself. To manage that insurmountable debt, the government is forced to print trillions of dollars. We have seen this exact cycle before. In 1971, under President Nixon, mounting debt and surging inflation forced the U.S. to sever the dollars linked to gold to keep the system afloat. Today, following the conventional investing playbook is a trap. It is a system deliberately designed to slowly erode your purchasing power, quietly siphoning your wealth to bail out the government's balance sheet. Surviving this environment requires completely abandoning the traditional 60-40 mix of stocks and bonds. You need to rebuild your financial fortress from scratch using 4 specific, battle-tested assets. The first component is physical gold, the real, tangible metal, not a paper promise, not an exchange-traded fund, and not a financial derivative. This introduces the concept of counterparty risk. Paper assets rely entirely on a bank or a government's promise to stay solvent. Physical gold has zero counterparty risk. It relies on absolutely no one to hold its value. Right now, 95% of surveyed central banks expect their own global gold reserves to increase over the next year. They are actively hoarding the exact asset needed to survive the fiat currency instability they themselves are creating. The second asset is inflation-indexed sovereign bonds. These are explicitly different from the standard fixed-income government bonds you see here. Normal bonds suffer from a silent tax. Because the money supply expands faster than the production of actual goods and services, inflation rises. The nominal value of your standard bond stays the same, but your real purchasing power quietly melts away. Unlike standard bonds that melt under pressure, inflation-indexed bonds mathematically guarantee a real return above the printing press. They form an unbreakable shield for the safe portion of your wealth. The third pillar is geographic and hard asset diversification. This means aggressively moving your wealth out of a concentrated exposure to US dollar-denominated assets and into global markets. The global economy is actively de-dollarizing. That brings us to the fourth and ultimate principle of portfolio survival, radical diversification through uncorrelated return streams. This chart illustrates the core mathematics. The goal is to identify 15 specific investments that move completely independently based on different economic triggers. The outcome? Even if multiple asset classes crash simultaneously, this structure reduces overall portfolio risk by 80%. Radical diversification isn't about perfectly predicting the future. It is the architectural structure that ensures no single catastrophic event can devastate your total net worth. We are entering an invisible capital war. Under extreme pressure, desperate governments inevitably freeze foreign assets, impose trade embargoes, and lock down their financial borders. History proves that supposedly safe assets can vanish overnight. We saw this in Russia, in Argentina, and across Asia in the late 1990s, where everyday citizens woke up suddenly locked out of their own wealth. A traditional investor caught in one of these localized panics is wiped out, but a globally diversified investor operates in an all-weather reality, completely untouched by the collapse of a single nation's financial system. Over 500 years of economic history, a clear lesson emerges. The people who survive massive monetary transitions are not the ones who try to outsmart the market during the panic. They are the ones who recognize the repeating pattern and prepare early. Right now, the window to restructure your portfolio is open. But when this capital war escalates, that window will violently close. The ultimate goal for the next decade is not maximizing short-term quarterly gains. It is aggressively taking action today to preserve your wealth and maintain your dignity through the total restructuring of the global financial order.